Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. The Fed now has released some details of its parameters for conducting stress tests of the 19 largest banks. More details are expected to be forthcoming soon. In the meantime, investors are going through stress tests of their own. And here to talk about that now with us is editor-at-large Steve Reitmeister, our senior market analyst Charles Rotblatt, and of course our top stock screener himself, Kevin Matris, all here at the roundtable. You know, there's this whole stress of just waiting for more details, if nothing else. But what have we really learned from these parameters so far, Charles?
Not much. I think the key point is we do not have an exit strategy out of TARP. And if there is one, Tim Gaitner is doing a very poor job of articulating it. And I know I've said that before, but I'm going to keep sounding like a broken record till Treasury Tim proves me otherwise. I do think one of the key takeaways, though, is there seems to be a sense that Citigroup and Bank of America are too big to fail, and they're going to do what is necessary to keep those banks alive and afloat. And I think where it does create stress is that we keep having this uncertainty as to what's the end game, how are we going to get out of this, how are we going to fix the problem. And I think with these stress tests, the problem is they're designed to actually create confidence, and my worry is it'll do just the opposite and really start renewing fears that the Treasury doesn't have a set game plan and they really don't have a way for fixing the crisis on a permanent basis.
Kevin, what do you think about all this stress business?
You know, it kind of seemed like a big non-event on Friday. Right. Everybody was waiting to hear what little bit we were going to hear. We finally did hear what little bit they told us, and it didn't amount to much. They gave us an idea as to some of the conditions that they were putting these banks under. Right. I think one of the worst conditions was looking at a 10% unemployment rate and a GDP of a negative 3.3% or something like that.
But didn't we know that already, though?
Well, we did, but what's interesting is that, again, I'm not sure if that is the worst case scenario, but it kind of shows where the Fed's mind is. Are they really expecting that, or are they just trying to figure out what the worst case scenario is and what kind of capital requirements will these banks need? I think it's kind of a treacherous situation because if the Fed does need to step in and if they convert these preferreds to common, in one sense, it would probably really help shore up the banks, but for an investor, it's treacherous because that would be massive dilution. So they're helping the banks, but the investors get shellacked because of it. So,
I know I'm getting stressed out.
Yeah, I think the main story here is that it was kind of a non-event. Right. Because I think most investors knew that this is a little bit of a PR event. They don't have much faith in that. You know, people knew that no one was going to get beaten up over the stress test, and so the reaction after the information came out on Friday was immediately things went down. Then they rallied back up, and then ended up right about where it started before the news came out. Meaning, kind of a non-event. This is what we expected, kind of vanilla information. And now we'll see. And taking a look at some of the over-the-weekend information, people put it a little bit under the microscope. Some of the stuff that I'm reading this morning is that the worst-case scenario is not worse enough or bad enough, and that an unemployment rate of only like 10% or something like 10 point whatever percent might not be enough. The GDP numbers are still expecting positive growth next year or slightly negative in the worst-case scenario. That's not bad enough. And so I don't think they really stressed the banks enough in the analysis.
Right. One thing I want to add, though, you know, Kevin's talking about possibly shareholders being wiped out, and there's obviously all this concern about nationalization. It's important to realize we have a long history of nationalizing banks. We've done it multiple times before. It's just that when you look at the scale of, say, a Citigroup, we've never done it on this scale. And so the question is, you take over something that big, you know, it's not the Tulsa, Oklahoma Savings and Loan. This is a massive bank, and I think the concerns are that it is such a big bank and it has so many arms and so many financial products. I think that's where the concerns about nationalization really start to set in.
Let's not kid ourselves; they're already nationalized. Okay, the fact that they are too big to fail, the fact that the government is clearly going to back the big guys the whole way through. We can call it nationalization or not, but really they're completely backed up by the government, and they might as well be nationalized. And here, they definitely want to have a say in some of the management and the compensation and a lot of other things. I mean, that sounds like management to me.
Right.
Well, and to add more stress onto the discussion, stress of sorts, we have now the market focused today, the 27th of April, on swine flu and whether or not this is going to be the next pandemic to hit the country, the world. So how do you feel about that? I mean, is that really a stress trigger?
It's funny because the market was down right away this morning, and then it's kind of bounced back to the time that we're having this conversation to relatively break even or slightly in the green on the day. So as far as the U.S. market's concerned, right now calling it a non-event on that information. But it seems, we're having a lot of deja vu all over again, that we keep coming back here every week, and here we are at 8,000, at 8,000, at 8,000.
Right, can't seem to get above it.
And the investor stress test, I think, is, the people who are bullish, when are we going to get above this?
Right.
And the people who are bearish, like, when are we going to get below this?
Right.
And who's right? And we can't seem to break out in either direction. And one of the things I've written recently is talking about, if the market can make a meaningful close above the recent highs of 81.31, then I think the people who are bearish have to reassess their assumptions and say, you know what, maybe I'm wrong here, maybe this rally has legs. And when those bearish folks start buying, this thing can fuel pretty fast upwards to 9,000. If the market falls meaningfully under these numbers, say towards 7,500 or so, and have a real retest of recent lows, not the 6,500, but then I think some of the people who are bullish have to reassess their assumptions and say, maybe we're wrong here. And when they start selling, we could maybe move towards 7,000 or retest of the low numbers. So that's the stress test, I think, right now, is you have this balancing act that we keep coming back to this week after week. It can't stay here forever. And so does it break higher or does it break lower? That's the stress test.
Yeah, I mean, stocks have not pulled back since March, significantly anyway. So the people out there who are looking to either get back in or still have money in, investors who are still riding it out, are sitting back probably saying, is this rally for real, Charles?
Well, we've gone on for close to 7 weeks right now. Not sure, last week. I think we actually did close up again for the week, which would be 7 weeks. Yeah, and so, but the thing is, when you look at first quarter earnings, everyone's like, oh, see, they're better than feared. Well, the reality is, the reaction to those earnings isn't very good. If you look at the companies in the S&P 500 that have reported over the last 2 weeks, the response by analysts has been pretty bad. Only 59 companies have seen their full-year estimates being revised upwards, but 81 have seen their full-year estimates cut. So analysts aren't taking these better-than-feared numbers and projecting them to being improved full-year earnings, and that's going to weigh on the markets. I do think we're going to get a pullback. If for any other reason, stocks never go in a straight line. It's always a jagged line. So we had a huge run-up. It makes sense we'll have a pullback. The only question is, how severe is that pullback? I do think it will be a buying opportunity, but I think the magnitude of any pullback is going to be determined by how messy the GM bankruptcy gets and what do we really do with the banks and what happens in terms of the government's intervention with the banks.
Right.
Kevin's already thinking about buying his mask.
What's interesting is that you would think trading this market after seeing this recovery would be a piece of cake, but it really is stressful because everybody is wondering when that other shoe is going to drop. Is this for real? Again, the rally that we have seen has just been met with such a huge degree of skepticism. You saw a lot of companies rebound nicely from the lows that we put in early March, but there's been lots of other companies that have seen such outsized gains that look to be way overdone. So even if the market didn't make new lows, and I at this point I don't see a scenario yet that would make the market make brand new lows, but if you do go down, since some of these stocks have gone up so much, you could see a lot of individual stocks get absolutely clobbered, and that's stressful because every time you get into a trade, you wonder, is this the stock that could get beat down if in fact things start pulling back? So a modest pullback could actually see some individual stocks get really, really hurt. But again, I think that, as Steve had said, if you can get above that 8,100-ish area with good volume, that I think will attract more buyers. Or if you can pull back to that 7,500-ish range, you'll probably see some good support. But if that support crumbles, you are going to make your way lower.
All right, well, no shortage of stress for investors, that's true. One thing is also true, however, that at least as of the time of this taping, the market does continue to prove resilient. With everybody here at the roundtable, I'm Terry Ruffalo.